Hi guys, this is Sia Jane and welcome back to my channel ACCA and Beyond. So in this video we are going to be revising chapter number 9, which is Internal Audit. So let's get started. So internal audit plays a crucial role in any organization. It is an independent and objective function designed to add value and improve operations. While companies establish internal controls to manage their activities, simply having these controls is not enough. Their effectiveness must be regularly reviewed, and this is where internal audit comes in. Internal audit acts as a monitoring and feedback mechanism, ensuring that controls are working as intended. Although not legally required, it's not legally required, okay? And having an internal audit function is considered a best practice in smaller businesses. Yeah, so just remember it. It's not legally required, but it is considered a good practice. Yeah, where was I? So in smaller businesses, internal audit may not be necessary due to direct owner involvement. However, as organizations grow in size, diversity, and complexity, the need for internal audit increases. It helps identify weaknesses in controls, supports better decision making, and ensures accountability across the organization. The need for internal audit also depends on several key factors. As the number of employees increases, so does the risk of fraud, making monitoring more important. Cost versus benefit is another consideration. If a company is losing money due to fraud, inefficiencies, or non compliances, and these losses exceed the cost of internal audit, then setting up an internal audit functions becomes worthwhile. Senior management may also require assurance and expert advice on risk and controls to help them fulfill their responsibilities. Additionally, if there is a weak control environment or a history of fraud, internal audit becomes essential to detect and prevent issues. Now, let's understand the difference between internal and external audit. This is an important topic for exams. Many MCQs or even a theory question can be asked from here. So, external audit focus on giving an opinion on whether financial statements are true and fair, and they report to the shareholders. Okay, so remember it. Just remember it's important. They report to the shareholders. Okay, and internal audit, on the other hand, focus on improving the company's operations. Okay, by evaluating internal controls, and they report to the TCWG. Okay, those charged with governance. External auditors are independent and their reports are publicly available, whereas internal audits may be employees or outsourced, and their reports are usually confidential. Overall, external audit is more focused on regulatory, while internal audit is broader and driven by the organization's needs. So now let's move to value for money. So VFM focuses on achieving the best possible results using the least resources. It is commonly explained through the 3 E's, which is economy. Economy means obtaining resources of the right quality at the lowest cost. Efficiency is about maximizing output while minimizing the use of resources. Effectiveness refers to achieving the organization's goals and objectives. Organization often uses performance indicators to measure these aspects and compare value for money across departments or even different organizations. This is especially common in the public and not-for-profit sectors. However, focusing on just one aspect can be misleading. For example, choosing the cheapest supplier may seem economical, but if delivery is slow or unreliable, it may be effective. Can you guys just give me 1 second? Sorry. Yes. So, for example, economy can be measured by the cost of medical supplies, efficiency by the number of patients treated or bed utilization, and effectiveness by recovery states or patient outcomes. Another key role of internal audit is to evaluate the design and effectiveness of internal controls and suggest improvements. The review is more detailed than external audit as it covers all areas of operations, not just financial reporting. However, internal auditors should not implement these controls themselves, as this would create a self-interested. Internal audit also plays an important role in fraud prevention and detection. Its presence can act as a deterrent, and in case of suspected fraud, it investigates the issue to identify what went wrong and who was responsible. Additionally, internal audit supports compliance with laws and regulations by monitoring activities and recommending improvements to reduce the risk of non-compliance. Operational audits are another important area, focusing on improving efficiency and effectiveness of the process. For instance, If process involve repeated manual data entry across departments, internal audit may recommend automation to reduce errors and improve efficiency. Overall, internal audit helps organization become more efficient, compliant, and well controlled. Uh, Manual process increase the risk of errors and are often time consuming and inefficient. So internal audit may recommend implementing integrated systems where departments are connected, eliminating the need for repeated data entry and improving accuracy and efficiency. When it comes to IT focus, external auditors mainly focus on whether they support reliable financial reporting and reduce the risk of misstatements. Internal audit, however, takes a broader approach. It evaluates whether the company is getting value for money from its IT systems, whether the procurement process was effective, and whether ongoing maintenance is appropriate. Internal auditors audit may also help project audits to assess whether specific initiatives like implementing a new IT system have achieved their objectives. In terms of corporate governance, internal audit supports compliance with overall control environment. Although not mandatory, having an internal audit function is considered good governance practice. Finally, internal audit plays a key role in risk identification. It helps management identify, assess, and understand risk, including their likelihood and impact, enabling better decision making and risk making strategies. A financial reporting system aims to produce accurate, complete, and timely information for decision making and planning. This includes financial statements, management accounts, and forecasts. Internal audit focuses on ensuring that this information is reliable and produced efficiently. If not, management decisions could be based on incorrect data. Another key objective is to assess the financial health of the business and ensure early identification of financial risk, such as currently fluctuations, interest rate changes, and rising costs. Internal audit mainly reviews the process and controls behind financial reporting to make sure they support effective decision making and risk management. In addition to this, internal audit also performs various ad hoc roles. These include mystery shopper visit to assess customer service, contract audits to ensure agreements are properly followed, and asset verification through physical checks. Internal auditors may also assist external audit in their work supervision. Overall, internal audit adds value by improving reliability, strengthening controls, and supporting business decisions. An effective internal audit function has several key qualities. Okay, so it is well resourced with sufficient funding and skill, experienced staff. It also needs to be well organized with strong work practices. Independence and objectivities are crucial, allowing internal auditors to provide an unbiased view. To support this, the chief internal auditor is typically appointed by the audit committee, and the audit plan is also set by them. Internal audit should have no operational responsibilities to avoid self-review threats and must have unrestricted access across the organization. However, there are some limitations. Internal auditors may lack full independence since they are often employees, which could make them hesitant to report issues. In smaller organizations, internal audit may be part of the finance functions, creating conflicts when reviewing their own work. Long-standing relationships within the company can also lead to familiarity threats. To overcome these challenges, organizations can ensure separate reporting lines, independent reviews of internal audit work, or even outsource the function to external professionals. This helps maintain objectivity and strengthens the overall effectiveness of the internal audit. Okay, so companies may choose to outsource the internal audit function instead of maintaining an in-house team. This means hiring an external professional firm to perform internal audit services. Outsourcing offers several advantages. Professional firms are usually independent and follow strict ethical standards. They have skilled and experienced staff with access to wider range of expertise and advanced tools. It can be more flexible and cost effective as companies can hire them when needed rather than maintaining a full-time staff. Additionally, uh, risks like staff turnover and training costs are transferred to the outsourcing firm. However, there are some disadvantages. External firms may lack knowledge of the organization, which can affect effectiveness. They may also be less flexible due to the contractual limitations, and in some cases, the focus on cost could reduce the quality of the audit. Fees can also be high, making outsourcing less attractive for some organizations. Therefore, companies must carefully weigh the costs and benefits before deciding whether to outsource the internal audit function. Outsourcing internal audit can also create an ethical threat. Um, for example, if the external audit firm provides internal audit services, it may create an ethical threat. In fact, for listed companies, auditors are not allowed to provide internal audit services related to financial reporting systems. So remember that this can come as an MCQ easily. There may also be pressure on independence, especially if management threatens not to renew the contract. In addition, organizations may have less control over the quality of work performed by external providers. When it comes to reporting, internal audit reports are not as formalized as external audit report. The format is usually agreed with the audit committee or brought before the board before the assignment begins, and the reports are mainly for internal use. A typical internal audit report includes the terms of reference, an executive summary highlighting key risks and recommendations, and a detailed body explaining the work performance findings. An appendix may also be included for additional supporting information. In exams, you may be required to act as an internal auditor, identifying control weaknesses, explaining the consequences, and suggesting improvements. Overall, internal audit reporting focuses on adding value by identifying issues and recommending practical solutions. With this, we have completed chapter number 9. It was a very small chapter compared to other chapters. The next chapter is going to be a bit long. I am thinking about dividing it into 3 videos. So let's see where it goes. And if you like this video, if you found it helpful, please like, share, and subscribe and share it with your friends. And thank you so much for watching.